What is call put options? Call and put options are financial derivatives that give investors the right, but not the obligation, to buy, call option, or sell, put option, a specific asset, such as a stock, at a predetermined price, the strike price, within a specified period of time, the expiration date. These options are commonly used in the stock market and other financial markets to manage risk, speculate on price movements, and create various trading strategies. Let's explore them in more detail. Call option. 1. A call option gives the holder, buyer, the right to buy a specific asset, e.g., a stock, at a predetermined price, strike price, before or on the expiration date. 2. Investors buy call options when they anticipate the underlying asset's price will rise, allowing them to profit from the price increase. 3. If the market price of the underlying asset exceeds the strike price before or on the expiration date, the call option holder can exercise the option and buy the asset at the strike price, making a profit from the price difference. Put option. 1. A put option gives the holder, buyer, the right to sell a specific asset, e.g., a stock, at a predetermined price, strike price, before or on the expiration date. 2. Investors buy put options when they anticipate the underlying asset's price will fall, allowing them to profit from the price decrease. 3. If the market price of the underlying asset drops below the strike price before or on the expiration date, the put option holder can exercise the option and sell the asset at the strike price, making a profit from the price difference. Key points to remember. 1. Options typically have an expiration date, after which they become worthless if not exercised. 2. Option contracts are traded on various exchanges, and their prices fluctuate based on factors like the underlying asset's price, time remaining until expiration, and market volatility. 3. Option trading involves both buying, going long, and selling, going short, options. 3. Sellers, known as writers, have the obligation to fulfill the terms of the option if the holder decides to exercise it. 4. Options can be used for various purposes, including hedging against price movements, speculating on price changes, generating income, and implementing complex trading strategies like spreads and straddles. It's important to note that options trading can be complex and carries a level of risk, and investors should fully understand the mechanics and risks involved before participating in options markets. Options are not suitable for all investors and should be used with caution, potentially with the guidance of a financial advisor. How to choose strike price? Choosing the right strike price for options is a critical decision and depends on your specific trading or investment strategy, market outlook, and risk tolerance. Here are some factors to consider when selecting a strike price for call and put options. Market outlook. 1. Consider your view on the underlying asset's future price movement. 1. Are you bullish, expecting the price to rise, bearish, expecting the price to fall, or neutral, expecting the price to remain relatively stable? Moneyness. 1. Options can be classified into 3 categories based on their relationship to the current market price of the underlying asset. In the money, ITM, a call option with a strike price below the current market price or a put option with a strike price above the current market price. ITM options typically have higher premiums but are more likely to be profitable at expiration. At the money, ATM, the strike price is approximately equal to the current market price. ATM options are often chosen for their balance between cost and potential profitability. Out of the money, OTM, a call option with a strike price above the current market price or a put option with a strike price below the current market price. OTM options are cheaper but require larger price movements in the underlying asset to become profitable. Time horizon. 1. Consider how long you plan to hold the option. 1. Short-term traders might prefer options with near-term expiration dates, while long-term investors might choose options with more extended expiration dates. Volatility expectations. 1. High implied volatility can increase the premiums of options. 1. If you anticipate increased price volatility in the near future, You might be willing to pay a higher premium for options with strike prices closer to the current market price. Risk tolerance. 1. Assess your risk tolerance and investment goals. 1. OTM options are riskier but can offer substantial rewards if they move in your favor, while ITM options are less risky but come with higher upfront costs. Premium cost. 1. Consider the cost of the option premium and how it fits into your budget. 1. ITM options generally have higher premiums, while OTM options are cheaper. Liquidity. 1. Ensure that the options you're considering have sufficient liquidity, as this affects bid-ask spreads and the ease of entering and exiting positions. 1. Highly liquid options tend to have narrower spreads. Diversification. 1. If you are using options as part of a diversified investment portfolio, choose strike prices and expiration dates that align with your overall portfolio strategy. Trading strategy. 1. Your specific trading strategy can also influence the choice of strike price. 1. For example, if you are implementing a covered call strategy, you would select a call option strike price that matches your desired exit price for the underlying asset. Risk-reward ratio. 1. Evaluate the potential risk and reward of each strike price. 1. Consider the potential profit if the option expires in the money compared to the premium paid. 1. Ensure that the risk-reward ratio aligns with your objectives. Ultimately, strike price selection is a balance between cost, risk, and potential reward. It's often a good practice to conduct thorough analysis, possibly using options pricing models, and to monitor market conditions before making your final decision. Additionally, you may want to consult with a financial advisor or expert if you're uncertain about your options strategy. How to trade on option expiry? Trading options on their expiry date requires careful planning and attention to detail due to the unique characteristics of expiration day. Here are some key considerations and strategies for trading options on their expiry date. Understand the expiration process. Options typically expire on the third Friday of the expiration month for most US equity options. However, there are exceptions, so always check the specific expiration date for the option you are trading. Options usually cease trading at the close of the market on the expiration date, and their final settlement is determined based on the closing prices of the underlying assets. Early exercise. Be aware that American-style options, most equity options, can be exercised at any time before expiration. European-style options can only be exercised at expiration. Options are rarely exercised early unless there is a compelling reason, such as dividend capture or avoiding dividend risk, for call options, or taking advantage of arbitrage opportunities, for put options. Expiration risk. If you hold in the money options near expiration, consider the risk of assignment or exercise. If you don't want to be assigned, it's advisable to close or roll your position before the end of the trading day. Closing positions. Traders often close out their options positions on or before expiration day to avoid the uncertainty and potential assignment, exercise risks. If you hold an option that is out of the money, OTM, and unlikely to become profitable by expiration, it's usually best to close the position to limit potential losses. Settlement process. Understand how your brokerage handles options settlement. Options are usually settled in cash if they are in the money at expiration. However, some brokers may automatically exercise options that are 1 cent or more ITM unless you request otherwise. Monitor market conditions. Pay close attention to the market and your options positions on expiration day. Prices can be volatile, and sudden price swings can impact your positions. Rolling positions. If you want to maintain exposure to the underlying asset but don't want to exercise or be assigned, consider rolling your options position. This involves closing your current position and simultaneously opening a new one with a later expiration date and/or different strike price. Day trading on expiry. Day trading options on expiry day can be particularly challenging due to increased volatility. If you choose to day trade options on expiration day, have a well-defined strategy and use risk management tools, such as stop-loss orders. Liquidity. Be cautious about trading illiquid options on expiration day, as bid-ask spreads can widen significantly. Stick to options with ample trading volume and liquidity. Plan ahead. It's generally a good practice to plan your options trading well in advance of expiration day. Know your objectives, set stop-loss levels, and be prepared to execute your plan promptly. Trading options on their expiration day can be risky and is typically best suited for experienced traders who understand the nuances of options trading. It's crucial to be well informed, have a clear strategy, and be prepared for various scenarios when trading options on expiration day. If you're unsure or new to options trading, consider consulting with a financial advisor or mentor for guidance. Thanks for watching.